So touch a little bit on what creates a payment, like what makes up the payment. It's not just what you're paying for the house, right? There's other factors that contribute to that.
Absolutely. So the 5 factors in a mortgage payment are going to be your principal, interest, taxes, insurance, and mortgage insurance if applicable. Now, when we send a realtor a pre-qualification or a client a pre-qualification, it could be for $400,000 because generally in the area that you're looking, that's what we think you'll qualify for. Now, a big factor in that, especially in Texas, is going to be your property taxes. And those can vary pretty greatly area to area. So because we send you $400,000, that doesn't mean it's a blank check that you have $400,000.
Yes.
If that's the top of your budget, we still need to run numbers and make sure that it's going to qualify as we go through the process. So at $400,000, you might not qualify for something at $375,000, or you might qualify for something at $450,000, depending on what those that mix breaks down to be. So it's really important through that process to work closely with your realtor and your loan officer to make sure that what you're looking at, that dream home, is going to qualify, and we're going to get you into it.
Definitely, because I know sometimes we'll have folks that'll show us something in, one ISD, one school district, and it's a perfectly great home, and it's within their pre-approval, number that's on the letter. However, that might be a higher rated school district, so the taxes do a big jump, right?
Absolutely.
So we tend to give Tanner a shout and say, we're going to show this home, everything checks out, on our due diligence where we call and check on some certain things. Then we'll give you a shout, and you'll also help us run numbers for the buyer to make sure that that higher tax rate or school district or whatever it is that's, upping those payments each year does still keep them within qualification.
Yeah, and not only keep them within qualification, but keeps you within a monthly payment that you're going to be comfortable with. Because just because you qualify doesn't mean that you really want to pay that monthly. Again, it's a quality of life conversation that we have with people. The school district tax in Texas is the biggest piece of your taxing. So if you go from one area to another, it can drastically change that. Now, if you have kids and that's the school district you want, then it's something that maybe you'll have to live with. But ultimately, we want to make sure you're aware of that up front before you even see the house.
And I know another question we get asked is, should I pay this debt off? Or, I got a bonus, I'm going to pay my car off, and things like that. Is that something that you would advise? Because I have a very limited understanding of credit, bureaus here, but the way I understand it is if you pay something off, you can dip your credit score, right?
Absolutely. It's best to have a conversation first, because that's exactly right. Let's say you have limited liabilities on your credit report and you pay off your car because you've been working towards that and you got this bonus and you want to pay it off and be free and clear. Sounds great, but what the bureaus look at is a mix of the types of accounts, the history of the accounts, and if you pay off your car and it was a long-standing, never had a late payment, good account, and you don't have a lot of other stuff to back that up, it will probably drop your credit score. So we have simulators that will help you understand what we need to do in the process of the mortgage and with those liabilities to do the best thing for you, not only for the transaction, but in the future as well. It's always best to have more money for the mortgage. A little bit extra never hurts. We can pay that stuff off at closing so it doesn't affect your score. Or we can just give you the guidance of post-closing. If you pay this off, expect to see a drop or whatever that may be. Just making sure that you understand the full ramifications of everything. You're eventually going to pay it off, but is it, when do you pay that off? It's very important.
Right. So I guess if somebody did accidentally do that and didn't reach out to one of us first to kind of just check that was, not going to negatively affect them.
Right.
If someone does that and they're still above that, say 620, but they started out at, 650 or 660, what's that going to do to their payment?
Yeah, so pricing for a mortgage is based on 20-point increments. 580 to 599, 600 to 619, and so on, right? So if it does drop you a bracket or two, it is negatively going to affect what that interest rate looks like. Ultimately, the good news is you can always refinance in the future, but if you're not in a really big rush, a lot of times we can look at your credit and inside of 30 to 60 days, do some minor things with your credit to boost it back up to where it was before. Okay. Ultimately, if you talked to me first, we would have probably gotten you up to more higher than what we get you back to, but there are always things we can do with people's credit. There's always money and time, how you can fix credit. And the earlier you talk to us, the more we can do for less money.
Absolutely. And then you don't have to pay that higher payment to make up for the fact that you're, in a lower bracket for credit. Because your credit can still be great, right? But it'll just cost you a little bit more a month.
Yeah.
Okay.
It's called loan level price adjustment. So every bracket, the investor is going to put a loan level price adjustment to make your rate just a little worse because banks leverage risk, and the lower your score, the riskier of a borrower you are.
That makes sense.